Good morning. It is August 30th, 2019. I am back from the hinterlands where I had very bad internet connection the last 2 weeks, and the videos were pretty choppy with background noise and everything else that could go wrong. But today, let's do a quick run through, kind of figure out where we are in the markets. Yesterday, I sent out a little note talking about volatility and how the market was setting up possibly to be set down, and what we can do about it. But I want to explain a couple of concepts today and then point some things out, and then finally end with oil stocks because something's about to change in oil stocks, I think. All right, first of all, volatility. We made a couple of volatility trades since the start of last year. We did one in January of 2018 and then one at the very start of this month. And both of those volatility trades were very, very successful. So if you are a member of Margin of Safety Investing, you will get that type of a trade once in a while. We're not going to swing trade individual stocks at Margin of Safety Investing like we do at Fundamental Trends. However, some of these bigger index-driven swing trades you'll continue to get. You know, the puts on the S&P 500 that I think most people made 50 to 150% on. The VIX trades, which I think everybody made triple digits on both times. And, from time to time, we'll buy puts on, ETFs or calls or something like that, when I think that there is a catalyst or a very high conviction setup going on, like there was with volatility several weeks ago. So let's take a look at what we did with those volatility trades. This is an article from January of 2018 where I talked about it's almost time to buy volatility, and we walked through how to do it. It's pretty simple, actually. You buy a call on the S&P, the iPath S&P 500 VIX short term. That's what ST stands for. Futures ETN, exchange traded note. It's important to understand that a note and a fund are different. An exchange traded note is backed by the credit of iPath, who I think is Barclays, and has an expiration. And we'll actually take a look at an example where one of these expired, came to maturity, actually. So if you haven't read this article, it's almost time to buy volatility. And I'll write something that's a little bit more updated the next time we do this. Go back to January 5th, 2018 and read this article over at Margin of Safety. And it's also on Fundamental Trends. I don't know if it's a protected article or not. I think if you go to Fundamental Trends, this article is probably available without a firewall. I think that almost everything that's older on Fundamental Trends, older than, I think anything from 2018 and back is probably not protected anymore. If it is, let me know. Happy to unprotect it so you can read it if you are just visiting our webinar today. So this is the VIX. The VIX is the volatility index. This is not the security. This is not the ETN. This is the actual index. And what we know is that when it gets down to around 10, it generally spikes up. Sometimes it spikes up more than other times. Last year, spiked up. We made and we were buying right in here. This is right where that article was. Let's make this a shorter term chart, make it easier to look at. You can see January 2018, almost time to buy volatility. And then we did, and bam. Now, when you're buying a call, say a $15 or $16 or $17 call, what did we buy exactly? All right, so we were selling puts for about $1.50, and then we were buying calls 25. All right, so now this is the VXX, which is not VIX. They're not the same numbers. but it's based on that. So if we put VXX in here, which I actually have on the other chart, we were buying right down in here. Look at that. We bought almost right at the bottom. Went all the way up here. So we were buying those calls for a few bucks, and they went up a lot. So a couple of people, I got out pretty quick. I just took my doubles and triples and went. A couple of people said they made 600%. So, you know, it's an interesting trade when you can make it. Now, we saw this spike in volatility. There was another one that we didn't really take part in, and it was because it wasn't an easy trade. You know, it was pretty choppy. And, you know, it wasn't that straight up move. Well, over here, we got the straight up move. And now it's come down. So where is volatility heading? Your guess is as good as mine. Is it going to do this? Right? Or is it going to just settle back down? I don't know. A lot of it has to do with the news that's coming out and whether or not there's a trade deal, whether or not anything goes down in the Middle East. Sounds like maybe not. All of a sudden, sounds like maybe there'll be a trade deal. But what if those things don't happen? You know, I think that we are in a very precarious situation when it comes to knowing what the short-term future is. I think that anybody who's trying to divine what President Trump will do, what Iran will do, what China will do, is, I think, reaching a little further than they should reach. And the potential to get out over your skis is pretty high. Somebody's going to get lucky and call 3 things in a row right and get rich, which is usually what it takes. And they have to be big things. Every now and then there's a huge bubble pop, and people who bet against the bubble can get super rich on one thing. But between now and then, all those people shorting the next bubble popping probably go broke because maybe the bubble stays inflated a little longer than they can stay solvent. So when I get a high conviction volatility trade, I'll let you know about it. So we did really well on this one, did really well on this one, didn't really take part in this one because I just didn't know. Didn't know if it was going to come down like that or if there'd be that big spike. And these options, you only want to keep in play for about a month, maybe 2 at the longest. So, you know, because the deterioration of the time value is so steep and the premiums are generally pretty high. So I had this chart already prepared. The orange is the VXX, and you can see, you know, we caught it at a bottom. Is it going to keep coming down? Again, I don't know. I mean, this chart looks like it could come way down here, get back down to that 10, 12 range, and twice we've hit in 12. The last 2 times we bottomed at 12. Over here, we actually bottomed under 10. You know, it was down in 9 something, which is just unheard of. So, you know, will we get under 10 on the VIX? Well, maybe they print a whole bunch of money. Maybe Jay Powell surprises us next month and cuts interest rates by a half point. But if he cuts by a half point, doesn't that scare you a little bit? Doesn't that scream out, wait a second, the economy's good and you're cutting it by a half point? And we're talking about cutting taxes again to juice things? Let that marinate a little bit. You know, why do we need all of these stimulative measures? Could it be slow growth forever? Could it be, let's see here, slow growth forever. Doesn't want to give it to me. Okay, how about here? Slow growth forever. All right, understanding slow growth forever. You really should read this because these things will not change in your lifetime. These are the structural, secular things that are going to go on that we are going to deal with for the next 30 years, maybe 40. So if you're younger, yes, you'll outlive this. And things will normalize in the middle of the century if we're not 100 degrees by then. So All right. Make sure you read Understanding the Slow Growth Forever Global Economy. It's very important. I also have it over at my, be happy if you visited my investment firm website. Why? Because it doesn't rank that high in the rankings anymore. So I would love for you to go over here and read it here. Understanding and Investing in the Slow Growth Forever Economy. This is both parts. It's the exact same article. So in any case, when we have unknowable volatility situations, all you can do is really rely on the technical indicators for the markets and the valuation measures. Let's start by looking at some valuation measures. If you go over to Advisor Perspectives, and I tell you, Jill Mislinski and Doug Short are two people you ought to be following. They update these charts every month. It is the easiest, cheapest way to get this information. And they cover the Crestmont Research PE ratio, the cyclical trailing 10 years, the Q ratio, and then they have a regression line. So if we take a look at the 10-year, also known as the Shiller index, which I have over here, and I found it over here as well. Don't really need that. But price to earnings ratios, people consider the wrong way. And they actually have an article here that talks about the use and misuse of the CAPE ratio. And I largely agree with it. I'm not entirely on board, but the 10-year average, the Shiller, right, the red one, which shows that the market's overvalued. And a little less overvalued right now than it was. But they all basically say the same thing. They're all pointing to historical valuation extremes. But they said that here and here and here and here. And it's been going on a long time. So now this looks like a bit like a topping process. I wish I could focus in on that. Over here I can. Let's look at the 3-year. Right, this looks like a topping process. Doesn't it look like it? It looks like it's maybe rolling over, right? So what does that mean? Well, what these really are indicators of is as the market becomes overvalued, how does that correspond to expected earnings? And if expected earnings go down, right, if forward-looking earnings head downward, then you have to consider, okay, the only way to keep stock prices up is if A, there's a lot more buying, and we just extend the valuation measures higher, right? We can have multiple expansion. And let's take a stock, just any random stock that has an earnings of $10 a share. And that stock is trading at $150. If the earnings drop to $8 a share, right? So the PE was 15, $10 a share in earnings, $150 stock price. That's a 15 PE. And the earnings drop to 8. How can that work out? Well, if the PE stays at 15, that means stock price is going to come down, right? By $30. If the stock price stays the same, that means the PE has to go up. So 8 into 150, whatever that is, 20 something. So if earnings head down, then either the multiple has to go up or the price has to come down. One of those two things will happen every single time. Because earnings have been growing up until recently, this all stayed okay. It didn't get beat up too badly. And in fact, started to chop around, stopped expanding. Why? Because the earnings were catching up. So if you look at all these charts, they all basically say the same thing. Overvalued, topping out. Could it go higher? Sure. people can keep buying. There's no rule that says people can't buy overvalued stocks. They do it all the time. So I encourage you to go over here to Advisor Perspectives once a month, take a look at these charts, and I would say read this article, The Use and Misuse of the CAPE Ratio. Okay. And it's, I think, pretty good. Now, people rip on the Shiller ratio all the time, right? And why do they say that? They say because it's not predictive. It's absolutely predictive if you know the earnings are about to come down. Bum, bum, bum. Are we going to have an earnings recession? Well, we know that earnings came down for the second straight quarter, and it looks like it's going to be this quarter as well. And there's a debate about whether this is just a blip and we're going to return to earnings growth next year, or if we're going to have a down year next year. You know which side of the fence I'm on. I think earnings go down next year. I think that the slowing of the global economy it's too late to change it. There is some retrenching that has to go on, and I don't put a lot of hope in any major stimulative actions going on. In fact, we heard European Central Bank today talking about, look, we're not going to go out and buy stocks. So, we're going to try to keep this economy going, but there's problems, and it's not just Spain and Italy and Greece, but Brexit. We don't know what's going to happen with Brexit. They're scrambling right now. So all of that uncertainty makes CEOs a little bit wary of extending themselves. So they buy back stock. They get their bonuses. It's the safest thing for them to do for themselves and protect their jobs. So right now, especially with the political uncertainty next year, do you expect any CEOs to be very aggressive in expanding their businesses? I don't. So I think there's going to be an earnings slowdown next year. FactSet has said as much. You can find that each month. Just type FactSet and Earnings Insight into the browser, and this will pop up every quarter. So these guys have some great charts. This is must-read stuff. And number of companies citing tariffs on their earnings calls. Look at that, starting to head up. Now, this is when it first happened. And then everybody became a little bit complacent. Oh, maybe it won't be so bad. And now, look at that. Now they're like, hey, yeah, this is starting to matter. Do you think there will be a trade deal? China expert says don't expect one. And I you can go online and find 100 of these. This one's in Barron's. And if you don't, I subscribe to Barron's. I'm not sure why I'm getting that big ad. I think the reality is starting to set in. What I talked about, back in February and then again in April, I said that, and the videos are out there, that we're either going to get a fake deal or a no deal, right? I've been on the side of a fake deal. I think there will be a fake deal because I think that Trump is going to have to cave in a little bit, and the Chinese will buy some grains from us, some gas from us, some other things, but they're not going to change how they do business. So I would think that there'd be a fake deal just to stimulate the economy going into the election. However, the other thing that could happen is Trump could say, no, China's not giving us a fair deal, and you need to elect me to see this through. And he could run that way. I don't know. Maybe he'll run and blame a slowing economy on everybody else. And to an extent, he'd be right. So, we'll see. And that's why I say anybody who tells you exactly what's going to happen next, people have to get over the whole idea of forecasts. You know, my forecasts have been pretty good. And when I say that I'm not really sure, or at least I'm not certain enough to bet a lot of marbles on it, you know, you should probably take a look at that. And there's been times when I was really sure of things and I bet my marbles wrong. You know, my oil trade sucked last year. So, you know, what are we going to do about that going forward? Well, let's not screw up. All right. So we just have to wait to see if there's a trade deal. And will it be short-term stimulative? Yeah, probably. Interesting headline here. Michael Burry, who I respect, is finally finding value in GameStop. That's a stock that we have been very in and out of. We bought it. We got a small profit, very small profit. And then I sold it because I said that they were going to go through a major retrenching and possibly burn through all their money. Well, he talks about some things here that I think I'm going to review because maybe GameStop is at the point where it's going to turn around. I don't know if anybody's still following it, but I haven't been into any of their stores since last August when I went to a zillion of them. Have they closed a bunch of small stores and opened up bigger stores with virtual gaming and things like that? I don't know, but that's what I thought they should do. So we'll take a look at GameStop because this is one that was on our radar. And my last recommendation was to sell it. It's down 50% since then, at least. But we'll take a look at it again. I'm not really sure if this is a value play or not, but he is a value manager. I mean, that is his general idea. He's a value manager. And if you haven't watched the movie The Big Short, you should watch it. I read the book ahead of time. It's a great book, too. So going back to the whole idea of can we see these ratios stay higher? Well, some investors are saying, look, we're not seeing the signs of euphoria that we normally see. And my response has been, well, that's because the boomers are in permanent selling mode, right? The boomers are gradually selling out of the stock market and will for the next 20, 30 years because they need the money to live on. And that is going to be a drag on stocks. So when you see one group selling into the market and another group buying, the millennials right now and institutions and hedge funds, you have to ask yourself a question, is this the normal shuffle? Well, it's not because of the size of the generations. So this is really a shift that's affecting a lot of different types of stocks. And underlying the market is just, frankly, and we wrote this article a year ago, less money. So suddenly there's less money because of the quantitative tightening. Now, quantitative tightening ended this month. And I said, well, I think we'll probably get a end of quantitative tightening rally at some point. Maybe that rally already started, right? Maybe all these things come together. But going into next year, if earnings are coming down and that rally is over and there's no new stimulus, and you're certainly not going to get it out of Congress, and tax cuts I don't think are going to matter. Because if they cut capital gains tax next year, what do you think people are going to do? They're going to be sellers. Why would they be sellers? To lock in their low tax rate. So there's a lot of reasons why I'm pretty bearish on next year, especially the second half of next year and maybe even the second quarter. So I think we need to mind our asset allocation very carefully. We need to be aware of what our individual risk tolerance is and try not to divine what is going to happen next. We should just wait to see what happens in most cases. If we can find value in specific stocks, go ahead and find value in specific stocks. What stock did we just buy? We just bought Invesco, the stock, not the bond, not an ETF, not one of their funds. We bought the company, the stock. So somebody asked in one of the chat rooms, I don't understand this relationship between Invesco and QQQ and everything else. Invesco is an investment company. They issue the QQQ ETF. It's their product. So between Invesco and BlackRock, I always want to say Blackstone, but it's BlackRock. Between Invesco and BlackRock, those are the two biggest players in ETFs. And Invesco I particularly like because they have some pretty good factor-based ETFs. Now, they bought Oppenheimer earlier this year, and they had a charge. What does that mean? It means they paid for it. They paid for the company they bought. So they are suffering from some slow growth right now because all that money that came over from Oppenheimer was mutual fund money. What do we know about mutual funds? The money's leaving mutual funds, and it's going into ETFs. So on one side of the ledger, this company is showing the losses on the mutual fund side, but then they're picking up most of that money back onto the ETF side. What's going to happen with Invesco in the next year or two is most of the Oppenheimer assets will be absorbed into the company. They'll stop bleeding those assets out or shifting them from one pocket to the other. And they're going to fire a lot of investment managers. A lot of them. So that's going to be a lot of labor costs that they save. And in fact, it's already happening. So I think we did pretty good to just buy Invesco. I think we waited for the whites of their eyes, or as I've talked about it in other places, the red of their eyes. We got Invesco. It had a pretty low money flow. So this is a monthly chart. And for the past year, they had stopped investing in Invesco. We really did a pretty good job here, I think. We bought low. So we got this stock back to the daily. Between what, right around 16, some of us bought it in the 15s. So anywhere from 15 to 17, I've been a buyer. So basically the last couple of weeks. I think you can buy this stock. They have a great balance sheet. They're growing, even though they have part of the company that's shrinking temporarily because it'll be gone soon, and then it won't be shrinking anymore. There was just a report out. I don't remember who talked about it. It might have been from Fidelity, but 60% of invested assets are now in ETFs, and 80% of new money is going into ETFs. There are not a lot of stock pickers out there. And one of the things that Michael Burry, he hit the news twice now, Michael Burry talked about a couple of weeks ago, is that there's a lot of great opportunity in small cap value stocks right now. There are a lot of small cap value stocks, profitable companies with good growth rates. So they're basically value priced growth companies kicking out dividends, right? $1 billion and $2 billion companies kicking out dividends, growing. They have their niches, and they're probably takeout targets, and these stocks are beat to hell. So that is actually something I've been looking at all summer. And you start asking yourself a question, well, which companies might get on our list? I think this is one that might get on our list. I think MSC Industrial might get on our list. Good balance sheet. Got some growth. Paying a dividend. Pretty important industry, but nobody wants small companies anymore. Right? This is a $3.5 billion company. It was $7 or $8 billion a while back. I believe it was up to $7 billion several years ago. So I think this is a company we're going to take a look at. Very, very steady Eddie company. Beat the heck over the last 2 years. Probably has 50% upside, and it's kicking out a fat dividend. It's not an official endorsement. I still have to do some more digging, but this is something that's on my radar, and there's like 8 or 9 others like this that are on my radar. All right, speaking of radars, Let's go over to oil for a minute before I take a couple of questions. These stocks are so beat up that there's only two things that can happen at this point. They get taken private, which is what I've talked about 2 weeks ago. I mentioned it in the comments of an article, and I was told I was out of my mind. And then 2 days later, there was a take private of I think a European oil company, Husky maybe. I don't remember who it was. Harold Hamm has said there's no point in having oil stocks anymore because nobody wants to buy them. So if they can figure out a way to privatize these companies to a small group of investors, private equity firm and the executives, they're just going to steal all these profits. And you know what they'll do? The minute these companies are private, they're going to tighten up the balance sheet. And they're going to limit the amount of drilling that they do. Why? Because now it's their investment. So if they don't take these companies private, it means that the stocks start to go back up. Is the Iran conflict going to happen? Who knows? I think that President Trump is unpredictable there. I think there are people who want to bomb Iran. And if there's not an agreement by Iran to seriously have negotiations in the next month or two, I think you still see the bombing this year. Could be next year. You know, maybe he does it going into the election because he thinks that'll help him win. I don't know. But my guess is that it makes sense for them to have the conflict, the bombing day this year, so that Saudi Arabia can ramp up production ahead of the summer. That'd be my guess. We'll see. But these companies, if you're a new investor in oil stocks, I just don't know how you can get something that's this low risk at this point. I mean, they're just so beaten to hell. I just don't see much downside. Here's the monthly chart. I mean, could it go down a little bit more? I guess. Pioneer is real likely to get bought as far as I can tell. If you take a look at Occidental, this one's already, I think, at oblivion levels. This stock should not be 43. They should. I think this company that should get taken private. They're insane not to just sell off parts and go private. But I think what they're going to do is they're going to sell off parts, and then they're going to become an incredibly attractive play. The dividends over 7%. That debt to equity is coming down quickly. Why? Because they keep selling stuff. They're not dumb. They're going to end up being a huge player in the Permian. I would love to see these guys merge with one more company in the Permian and sell everything else, right? Just take what they can get for everything else, become a Permian resources company, water, gas, and oil, pipelines. But we'll see. I don't see there's hardly any downside to Occidental right now, but I said that at 50. So, there's that. But at 7% dividend, increasing the dividend, doing buybacks, selling off parts for cash to reduce the debt, I don't know. I don't see how you get much better than that. Shareholder yield is going up. The only thing that keeps people selling oil stocks is that they're already going down, and people have recency bias. So there's no fundamental reason why this stock should be getting beat up. There's no fundamental reason why Pioneer should be getting beat up. But they are. Why? Because the momentum is down and people are scared, and they're just not gonna do it. Carl Icahn issued an open letter to stockholders, so I guess we'll have to read that. In any case, so I'm going to finish off with this. The shareholders at Chevron and Exxon are against acquisitions. The shareholders are dumb. Exxon and Chevron should be eating everything they can eat right now. This is like a prime rib seafood buffet for $9.99. A good one. Not like a bad one, a good one. And they should be out there buying everything they can buy, and the shareholders should shut up. because they don't know what they're talking about. The shareholders vote for incredibly high compensation packages for the executives, and now they're going to tell the executives what to do. Shut up. Most of these people have no idea what they're invested in. They have no idea that Chevron and Exxon are going to have to split themselves up at some point. They just don't understand the businesses. And I will tell you this, 90% of investors, probably higher, probably by quite a bit, probably 95, 96, 97% of investors have no idea how the companies they're invested in work. They don't. They don't read the corporate documents. They don't have somebody like me read the corporate documents for them. They just, oh, look, it went up. I'm going to buy it. Oh, look, it went down. I'm going to sell it. I just read this headline. I'm going to do something. They have no idea. Exxon and Chevron should be out there. Chevron should go to Occidental right now and say, hey, we'll give all your executives really good jobs. We'll buy the company for $60 a share. Let's just be done with this. That's what Chevron should do. Be easy for them. And we're going to issue shares to do it. We'll issue the minimum amount of cash to avoid a vote. That's absolutely what Chevron should do. Or Exxon, either one of them. All right, so let's take a look at questions for a few minutes. We'll switch over to gas in a second. ECA, what is going on? They screw shareholders with Dutch auction, lowering stock price artificially. Dutch auction had nothing to do with the share price going down. Right? The share price was already down, so they were like, let's buy some shares. That was good for shareholders. Now, you should have told them, no, I didn't sell them any shares. Let them soak up the scaredy cats shares. So that Dutch auction for Encana shares, I think is over, expired now. I saw the last call notice a couple days ago. But yeah, you don't want to sell your Encana shares. Encana is cutting debt, raising the dividend, and buying back shares. Cutting debt, raising the dividend, and buying back shares. That's nirvana, right? That's exactly what you want from a company. So we're probably not going to make money on the 2020 calls unless there's a conflict in Iran or something drives these prices up in the next 4 months, 5 months. But honestly, I want these shares. They're paying a dividend. Stock price has nowhere to go but up in the intermediate and long term. Who knows what the short term holds? And if I'm right, and President Trump loses next year, then the Democrats will put the screws to a lot of different drilling ideas, right? They'll take away public land drilling again. They'll shelve all the offshore development, and they'll just tighten the market up because they want the price of oil and gas to be higher so that we stop using it. These companies all become very profitable in the short term. They start pumping out a ton of dividends and buying back shares. I mean, these stocks literally could go up 5, 6, 7, 800% in the 2020s, just because there are going to be fewer and fewer shares paying bigger and bigger dividends. And ultimately, even if these companies are on a 30-year 30-year die outs, right? Even if they're going to disappear over 30 years, they're still going to pump out a ton of money. And that is why I think some of them are going to go private. There's very smart people out there in private equity and in management who are like, why don't we just buy these companies and then let all the profits come to us? I think that's realistic. We'll see. Antero, natural gas. Again, if I'm right, natural gas is going to have its day in the sun, and I think a lot of this does revolve around the 2020s. You see what Ohio is doing. Ohio is subsidizing nuclear power plants that shouldn't be open anymore, just because they're that old and unprofitable, at the expense of natural gas. and they're subsidizing coal. So Ohio is just ass backwards right now. They're doing some really stupid things. So, I think that natural gas stocks are pretty good right now. You're going to have to be a long-term investor. You can trade them. You can day trade them. We don't do that. And maybe we have some catalysts for some swing trades, especially on XOP, because I don't know that, at margin of safety, we would do a swing trade on XOP, but not on the individual stocks. And if we see that we're ramping up for a conflict in Iran, we would do a just-in-time couple of call options, right, on USO or on XOP or something. Are you interested in organize a private Mosey investorship? What does that mean? I don't know what that means, Vince. So anyway, somebody asked me a question in the chat, and I don't know what it means. But that's not the first time. I did not update the asset allocation on our VSL, but I put in there what I think it'll go to. So the top asset allocation is what I think it will go to if we become buyers. But that second asset allocation is still in effect, still very heavy in cash, right? Over half in cash for moderate and conservative investors. And the aggressive investors, I think, are 35% cash. I'd have to double check. You take us private in an energy company? Oh, wow. I don't think we could raise enough money. I know a guy. I'll talk to him. I'll see how that works. I do. I mean, remember Dallas? The heck is Dallas's last name? Well, there's a guy that used to write for Seeking Alpha, and he lives in Austin. I've talked to him a few times. He's got some articles on Seeking Alpha you can find. He was Dallas Salazar, right? Is that his name? He's into that sort of stuff. I'll check with him. I'll see. If you want to take part in a take private, what you have to do is buy into the private equity fund. And the private equity fund that gets involved in that, you'd have to be an accredited investor, meaning that you have $1 million net worth, or you earn, I think it's $300,000 a year for 2 out of 3 years, something like that. Look up accredited investor. If you're an accredited investor, you can buy private equity, and I have that available. If any of you are, millionaires and looking for private equity investments, I've got that stuff. KKR, I've got those for you. And I just charge an hourly fee to get you involved. I don't even take a commission. So, if you're really interested in that, let me know. But you do have to be an accredited investor to do that sort of thing. All right. Let me talk about my trip across the country. So, 19 days ago, I left on a Tuesday from Milwaukee to head out east. Went to Cleveland, spent a day there, made a few $100s playing Omaha at their Jack Casino downtown. I will say, if you're an Omaha player, go to Cleveland. It's an interesting game. They usually have 2 or 3 tables running, feeder tables. There's not a lot of places you can get Omaha games. Then we headed over to Springfield, Massachusetts, just to sleep for a night, because Boston is super expensive. Spent the day in Boston, went to a game at Fenway. We went to a baseball game in Cleveland, too. I know there's a lot of romanticism about the old ballparks, Wrigley and Fenway, but they suck. They're stinky. The views are bad. It's hard to get in and out. Give me Miller Park. Give me Riverfront. Give me, Progressive Field over in Cleveland. I'll take the new stadiums any day. I don't mind looking at the old stadiums or doing a tour, but I don't want to watch a game there. I understand it's what they have, and they're in love with it, and love is irrational sometimes. So, hey, enjoy it if you're in Boston or Chicago. Enjoy Fenway and Wrigley, but frankly, they're crummy stadiums. And they've done a pretty good job of remodeling both. I don't know what else they can do. In any case, what I really want to talk about is not what I did, but what I saw. And I'm actually going to write an article, and I'm going to try to get it into the New York Times, because there's still a possibility that President Trump wins. And here's how it would happen. And if you don't believe me, go for a 3,000-mile drive like I did. And if you're a trucker, talk to your friends. I mean, I don't know if we have any trucker investors here. Actually, I thought about doing a website called Trucker Investor. And just pretending to be in my alter ego, I'd be the trucker that drives around the country, which I might still do. I might still decide to just drive around the country. In any case, there are places between Milwaukee and the East Coast in New York, in Pennsylvania, in Ohio, in Indiana, in Michigan, West Virginia we didn't get to, but I would imagine this applies there too. Some of these states, these flyover states, that is going to be in the title, I think, are still depressed. And Wisconsin is doing pretty well. So I don't think President Trump wins Wisconsin. There's a huge upswell against him here, and the economy is pretty good. So I just think some of the angst, some of the never Trumpers, I think, are going to stay home. So I don't think he wins Wisconsin. But my friends from Boston were on me about, look, man, you can't let Wisconsin go to President Trump. And I'm like, that's not up to me. In any case, there are places, Indiana, Ohio, Pennsylvania, upstate New York. I mean, New York will never go Republican. But when you take a look at what hasn't happened for them economically, what good things haven't happened for them, you have to understand they're still frustrated. There are people in towns who can't get jobs because the major employers left 10, 20, 30 years ago. And some of these towns, I'm telling you, especially the ones in the Great Lakes region, if they're close enough to the Great Lakes, and most of the places we were at were, they're spectacular real estate investments waiting to happen. Because ultimately, we have to let a lot more immigrants in this country to stimulate the economy. We're not going to breed our way to a stronger economy. We just have to. We need 3 million people a year almost to come into this country and help stimulate the economy. We can't do it by printing money. We're going to try. And I do still think that helicopter money is inevitable because we're going to have to bail out Social Security and Medicare somehow, and might as well bail out a few other things too along the way. Hopefully we bail out from the bottom up, not the top down. But there are places in America that you can look at and see how beautiful they were 30, 40, 50 years ago. And remember that quote from President Trump about shithole countries? I'm telling you, there are shithole places in this country that we should be ashamed of. The jobs left, usually due to technology, not going to China or Mexico. Usually due to people on the East Coast deciding that financially it was better to get rid of the job and automate it and somehow use the corporate structure to enhance their wealth in an office somewhere. And I think that we have to be very cognizant of that frustration because it manifested itself in some ugly things the last 3 years. There's been a rise in racism. There has been, take a look at the, what do they call it? The angry driver thing. Road rage. Road rage is up. Domestic violence. You know, you take a look at what's gone on in the last 3 years, and I don't think it's ideological, really. I think people adopt an ideology to validate themselves and what they're doing. But I think that we have a lot of financial frustration, economic frustration, a lot of feeling threatened going on in this country. There's a lot of politicians who lie, who say what they need to say to get elected. They don't tell the truth. They have all the information and they don't give it to us. You know, I dig and dig and dig to get it. So, yeah, mass shootings are up. So all these things that we spin negatively, and then Scott Walker, one of the reasons I think he got beaten in the election is because he got caught saying on a live mic, yeah, the divide and conquer strategy is working. That's how he got elected. That's how Donald Trump got elected. We can't let politicians divide us, because ultimately we're the ones who build everything, who make this economy go. And we do have the best big economy in the world. It's not even questionable. But the wealth inequality, and this is something I'm writing this weekend, is so off the charts at this point that we have to do something about it. And we end up getting stupid, crazy ideas like we'll just soak the rich with taxes. Well, why don't we just fix the tax code in general? Why are capital gains tax rates lower than income tax rates? Anybody have a good answer for that? I know what the theoretical answer was 30, 40, 50 years ago. There's no shortage of capital anymore. You don't need to incentivize capital investment anymore. Capital gains rates and income tax rates should be the same. And that would increase the standard of living for everybody in America, except people who don't pay income taxes because they're paying low capital gains taxes. Why does Warren Buffett have an effective tax rate of like 17 or 18%? And I have an effective tax rate of 24, 25%. That's dumb. It's just dumb. So there are things that I saw around this country where it makes you cry. I have some pictures that I'll put into an article. And it makes you think, okay, whose fault is it? It's not the Democrats' fault or Republicans' fault. It's all their faults. But I will tell you, this whole divide and conquer thing, I vote based on two things. And I told my cousin this one year. I vote based on two things, and then if those two things tie, I go to everything else. I vote on two things. Will the people coming in office get us into a war that we don't need to get into? And will they crash the economy? I know people want to say, well, abortion is important to me, and this is right is important to me, and that thing's important to me. You know what? If we're at war and the economy crashes, none of that stuff matters. Start there. And then put the social issues and other things underneath that. Please. Vote for your life, and then your wallet first, and then everything else. Now, what you will generally find is that middle-of-the-road candidates are the best. The extreme right and the extreme left typically pull us too far in one direction. They break things, and then we react and go too far to the other side. So we'll see how this all goes, but I'm telling you, there's a possibility President Trump wins because there's still a lot of frustration in the middle of the country. I didn't think he could win Pennsylvania. I'm not so sure that's true anymore. I think he's probably going to win Ohio, and I'm not sure about Michigan. I didn't get too deep into Michigan. So I would imagine there are states that were decided by less than 2% where frustration levels are high and Trump can run on it's somebody else's fault. Maybe he picks up a Nevada. Maybe he holds on to Florida, right? Maybe he gets a couple of those Democrat states that barely went Democrat. I don't know. I mean, there's clearly a path to victory for him. I think it's unlikely, but if it happens, it's because the East Coast, and I hate to tell people in New York and Washington, D.C., I say the East Coast. It's really D.C. and New York. The people making decisions in those two cities, or they're connected to those two cities, have made it very difficult to live in flyover country. And the looking down the nose, and I heard a conversation 2 women with Long Island accents. It was beautiful. I say that with my Midwestern nasally accent. Talking about how the people in flyover country just didn't understand. Well, here's what people out east need to understand. We grow the food. We build most of the stuff. And there's a lot of people in the Midwest who are pretty tired of having their jobs taken away one way or the other, having their stock go down, having their wages be stagnant for 4 decades. 4 decades. So that would be the frustration that gets a candidate like President Trump reelected. So I'm just saying, I don't want to make a huge bet on President Trump losing, even though I think it's probable, because the level of frustration, if the economy gets bad next year, that might actually be good for President Trump. And he can run on everybody else is screwing up and not let me do what I want to do. Will 51% of the people believe him? I don't know. I think I don't think that's really what's going on, but it could happen. So we have to be careful in how we look at things the next 16 months, because there's a lot of unknowables and there's a lot of things that could get broken worse before they get better. And we just have to be careful. So in any case, have a great Labor Day weekend. Do something fun with people that you love, or at least people that you like, and don't get in any trouble. But, we're going to get through what's coming, and we're probably going to come out of it pretty well, because most people don't take the time like you do to even try to understand what's going on at the micro level with companies or at the macro level with the government and the big secular trends. We're so far ahead of everybody else that once we're over that crummy oil trade, which will probably just take time, people are going to look back and go, geez, look at all these good stocks that we bought. Nutrien, Invesco. I'm going to write down the list. There's like 20 of them. We bought gold stocks at exactly the right spot, right? Newmont and Core, those are both up for us, and I think they're going higher. So, we have a lot of things going for us. If these oil stocks ever rebound, or if we just get out even, we're so far ahead, it's unbelievable. We're talking many, many points. Sierra Wireless, somebody just asked about. I'm actually going to write 2 articles for Seeking Alpha, and this is roughly what the articles are going to say. Sierra Wireless just cut a deal with Microsoft to get onto their Azure platform, and they are co-marketing with Microsoft. Their 5G solutions are going to roughly double their revenue in the next 2 years or 3 years. Now, the technicals say that Sierra Wireless can go down to like 8, maybe even 7 or 6. Right? There's nobody's investing in Sierra Wireless because people get frustrated when things don't happen right away. 5G is not even built yet, but the weekly is starting to turn up a little bit, but the daily still has been going down. So the monthly looks like it's bottomed. The weekly is starting to inch up, but we still have this downturn right now. So Sierra Wireless 1060, could it have a little digger here? Get down to that $8 range, $6, $7, $8 range? It could. But if you want to nibble just a little bit to have a starter position, go ahead and do it. That's what I've got. I haven't bought any more yet because I'm a little bit afraid of that 6, 7, 8 range. But if it gets down to 6, 7, 8, I think you probably back up the truck. Because I think their deal with Microsoft is a big deal. All right, I'll let you go. Have a great Labor Day weekend. I'm going to try to get a couple articles out. I think the article I'm writing about flyover country, maybe re-electing President Trump, I'm going to try to get it in the New York Times. I understand that you say not the New York Times, but it's the perfect platform. for that. If they don't take it, I'll submit it somewhere else. It's not going to be an editorial. It's going to be an actual article that I'm going to try to get published in a big paper. So you guys have a great time. The other article I'm writing this weekend has to do with the disparity between labor and financial capital. We favor financial capital over labor, and those things have to balance out. And that would largely get rid of the wealth inequality in the country. It's not that hard. Go Cubs. Come on, man. Yes, the Brewers do need to sweep the Cubs. If anybody needs tickets, my tickets, two of two. I have tickets to all 4 games. 2 of them are for sale if you want. Call me if you want them, actually. So, all right, take it easy. Have a good weekend.